G'day, folks. Welcome back to another edition of the Rough Consensus podcast. And today is an absolute ripper. We're going to be talking with Doc Severson, who I consider to be my market mentor. He taught me almost everything I know in terms of how price trades, how markets work, everything about market psychology. I have learned just a tremendous amount from Doc over my years, and so many of the concepts we talk about today, you will see reflected throughout my work in on-chain data, because it is just so fundamental and so core to understanding how human beings are herd animals, and we all tend to behave in the exact same way. We experience the same emotions, and more often than not in markets, it's one of those few industries where it's almost always the wrong thing to do. So you really have to be that inner contrarian and look at your own emotional state and how you're thinking about things, because more than likely than not, there are many people who are doing the same thing, and that's often the exact wrong decision. Now, for Check on Chain newsletter premium subscribers, you'll actually be getting this particular episode a few days early, because at the end, we spend a bit of time with Doc in the charts, actually looking at the current market sell-off. We're trading about 53,500 at the time we were recording, and we were in the process of selling off, and we really wanted to explore from Doc's perspective, with 2 decades of market experience, how he's thinking about these current market dynamics. So we will release this for the rest of our audience a couple of days later, but for premium members, because it's a bit of a timely update and just giving people an understanding of where Doc sees the market and how I kind of bounce those ideas around, we wanted to give it to our premium members just a couple of days early as a bit of an advantage. So if you're not signed up at Check on Chain, head over to checkonchain.com. And otherwise, I really hope you enjoy this episode. Cheers. G'day, folks, and welcome back to another edition of the Rough Consensus podcast. And this one I'm really excited for, because we have Doc Severson on. And Doc, you've probably heard me, if you're on the Check on Chain news, you've heard me refer to him in the past. He is probably the man who's taught me more about markets than anyone else. I actually consider you as my market mentor. A lot of the market psychology side of on-chain data, really, I learned a lot of these lessons from Doc. So Doc, it's absolutely fantastic to get you on. And how you doing?
Oh, I'm doing great, doing great. It's now about 20 years in the business, so somehow I've survived all the ebbs and flows and everything. So it started at around 2004 is really where I began my career.
Yeah, so I think that's probably a good place to start. If you want to give people an introduction of how you actually got into markets, because it's one of those things a lot of people just find themselves in. They just, they don't necessarily set out from school and say, hey, I'm going to be a trader, I'm going to be an investor. You kind of fall into it. But how did you get into markets? And then following on from that, how did you discover Bitcoin and get into the crypto industry by and large?
Oh, okay. So I was in the high-tech business. I was in communications. My companies that I worked for in networks, we connected people from point A to point B. And this is well before the internet. So we were sort of the internet before it existed. And because of the fact that we were in high tech, there was a lot of my coworkers that were always dealing in stocks and talking about stocks. So I just sort of got that rubbed off on me, and it became sort of the office hobby for everybody to talk about stocks and what was going on. And so I opened up a Schwab account. This is in the mid 1990s, to kind of date myself, but those were in the days where commissions were $29 into a trade and $29 out. So think about that. You have to clear more than $58 on the whole trade just to make money on it. But those were wild days, because that was the .com boom. So anything with a .com at the end of the business name basically had people just throwing money at it. And it was amazing times. It was like fishing in a trout pond. Like anything that you would put money into would go straight up. And then I wrote it a little too long, right? Just like everybody else. I rode this a little bit too long, and we fell over the edge and things started heading down, and I clung on to it with both hands, and I took the thing down. I had actually given my money to a money manager to, hopefully do better. And they took it down to 30% of its original value. And I'm like, okay, I've got to do something about this. And then I ran into a seminar, an educational seminar that taught you how to trade stocks and specifically options. And that's where the light bulb went off. And I realized at that moment, it was kind of a strange thing, but I'm in this 20,000 seat theater. And I realized at that moment what I wanted to do with the rest of my life. It was like, the sun shone in from the windows, that kind of a moment. and I just put myself into it with everything. And so that was about 20 years ago when that happened. And it was about 18 months later that I quit my job and went out solo, and it was just trading for a living. And it was that was the beginning of quite a journey. And I've had lots of ups and downs along the way. But I think, as we'll talk about today, it's a lot of the same things that happen. You learn a lot of the same lessons. You hear people talking about this and saying, hey, you have to do it this way or that way. And you're like, yeah, right, whatever. And then you find out that you learn those lessons yourself and they stick with you. Because the whole idea about trading is, if you want to make it long term, you can make a mistake once, but never do it again. And so just continue to get experiences, and then eventually you'll learn a different way of thinking. The market thinks very, very differently than how most people do. So
Yeah,
that's kind
absolutely.
of the 2 minute drill here about my background.
The 90 sounds very. I can see why you got into the Bitcoin and crypto space, because it's almost exactly the same as where you throw money at a wall and stuff seems to go up and up, left, right, and center. But I 100% agree on the experience and the learning lessons. I did my talk in Nashville to a room of about 9 people because Michael Saylor was on at the same time, and it was looking at all the mistakes that I made in 2018, which is actually when I discovered your work. And you think that, don't worry, I'll sell it back here because I'll buy it back later. And then I now look at that on-chain data, all the other dumb money, just like me, was selling low, thinking they were going to go back higher, and then it rallies. And then you go and find, oh, look, I found my new favorite indicator, and you start tracking that indicator. You have no experience in it whatsoever, but it's telling you to be bullish. That's the exact time when everyone else is selling. So it kind of gets me on the main thing that I think is so fascinating about markets is the psychology and the crowd behavior. And this reality that the natural drive that we have is almost always the exact wrong thing to do.
Oh, absolutely. And that's the one of the most frustrating things to people that join financial markets, because most of them will join a financial market or get interested in it because the price is zooming higher. And psychologists have actually proven that the greatest amount of pain that you can feel in a financial market is to be on the sideline while the market is zooming higher. So you check on it every day and it's zooming higher. It's leaving the station without you. It's actually more painful to watch that than it is to actually take a stop in a trade that doesn't work out for you. So this is why people get attracted to it, kind of like flies to a blue light. They go straight for it. And then they realize after a while that, wait a minute, something's wrong here. And a lot of times they'll blame it on, well, this is a rigged market, or this is manipulation, or this is, a Ponzi scheme. So they'll give it all kinds of terms, but it's nothing of the sort. Now, there is some manipulation if you get into very low liquidity coins. So a lot of altcoins can be like that. The ICOs were particularly bad, and they get manipulated through Telegram pump and dumps, which is why generally I'm telling people to stick to the majors, stick to the higher liquidities where one person or one entity or one pump can't really take you out of the game. But that this is the way that price discovery works with this, is that people are attracted to this, and then begins the sort of long list of lessons that they have got to learn, which is to think differently. You can't think. One of the biggest problems that I see right now is what I call just the whole social trading platform, where everybody just wants to join a Telegram or a Discord and just follow along. The problem is, if you do the same thing as everybody else, you'll get the same results as everybody else. And so what you have got to do, and this is something that you're really, really good at helping people do, is to think differently. You've got to be independent. I almost don't want to hear what other people have to say about the market, because it requires that level of isolation so that you don't get these very natural human biases that we all are susceptible to.
Yeah, I fully agree. And I was talking about on Twitter, I think it was yesterday, when you start to see all the guys, the reply guys in your comments, and they all seem to coalesce around a particular price. I remember it back in the 2018 bottom, we were at 3,000 and $1,000 became the price target. Every man and his dog was betting on 1,000 and we went to 14. And then there was again when FTX collapsed, right? We're at 15K. Everyone says it's going to 12. I'm not buying it into a 12. and we ended up going up to 40. So that's like the nature of the beast, is that people always have this like crowd mentality. And when they're all on the wrong side of the boat, it's almost always what flips it back the other direction. So I think there's probably two questions there. Why is it that people naturally follow that instinct to get on the right side of the boat? And then on top of that, why is it that the market then swings back the other direction? What is like the mechanics at an individual and then a collective level that drives those two things to actually occur? Why does this happen?
Oh, I love this question. So first of all, why do people follow, like, we are herd animals. I mean, we are the worst example of a herd animal that's out there. What is most of us, I mean, we're approaching the weekend here, and one of my favorite things to do is to sit with 100,000 of my closest friends in a football stadium and watch a college football game. And it feels great to be part of something bigger than yourself, where you're all rooting for the same thing, and you're one of a big collective. There's nothing that feels better than that. Unfortunately, in investing, it's the absolute worst possible thing that you could do. Just because when everybody is going in one direction, who's going to be the next buyer? There's nobody left, right? So it's almost like you hit an air pocket and there's nothing left to go. You've driven as far as you possibly can go. There's no additional buyers that have come on board or are available. Everybody has bought that's going to buy. And all of a sudden, this is where the sellers come on board. And it starts very slowly, and then it starts like an avalanche. And all of a sudden, this is where we get into part two of your question, which is like, why did these moves happen? And it's because you and 5 million of your closest friends have the same exact problem. And you get into fear. Fear drives the markets higher. It's fear of missing out, or FOMO, as we already call it. But to the downside, it's fear of loss. Like, oh, I don't want to lose anymore, or I remember the last time I lost and I'm going to sell now. And all of a sudden, it just becomes this sort of, virus that spreads throughout a holding community and people are always going to do what comes to them as in their own self-interest, right? So you've got 5 million people that are holding this asset, and they're all going to act in their own self-interest. And so this starts this chain of events, this sort of snowball or avalanche of selling. And then it happens in the opposite direction, right? So all of a sudden you get the selling coming along and you get these waterfall declines, and the opposite extreme can kick in, that all the sellers have already sold. Everybody that is going to sell is already sold. And then now's the time for the buyers to come along. So it becomes this sort of opposite day. Every day in the market seems to be opposite day because the conventional wisdom is almost universally wrong when it comes to markets. And this is why you've got to approach every day asking yourself, okay, I don't know what's going to happen to the price. And that may be another point here, but look, nobody knows what's going to happen tomorrow. I don't know what's going to happen in the next 5 minutes. I will never get on a podcast and say, well, due to my superior technical skills, I can forecast with a 98% accuracy of where things are going to go. That's BS. Nobody can do that. Nobody knows what's going to happen tomorrow or the month after. But what you can do is you can set yourself up to act regardless of what the price actually does. So the very simple action of talking to yourself in the morning saying, okay, I have no opinion of where the market's going to go, but this is what I will do if the market goes higher from here. This is what I will do if it goes sideways. This is the action that I will take if it starts going down. And to be able to just do that will set yourself apart from probably 98% of most investors who are going to hold their bags down into the ground because they don't have a plan.
I've been kind of taken this concept, and I can't predict the price, but I can prepare for it. And this idea that the markets are like the tide. If you swim against the tide, you will go out to sea, you will get exhausted, and you won't make it. But if you accept that the tide just is, and none of us can change it, none of us are big enough to do anything, all you can do is pre-think about what you're going to do when A or B event happens. If we were to trade lower, rather than being the person going, don't worry, I'll sell now that we're down 45% and I'll buy back lower. Instead, maybe like pre-think, perhaps I should not be the seller down there and I should actually be looking for opportunities and just flipping it around saying, what will I do? So when it happens, you don't panic and you kind of hit this point. You go, I've already made the decision of what I'm going to do.
Something else too is that people think that they have to trade in these huge blocks, right? So, I'm going to put 10,000 into this position, and they have to wait for the exact perfect moment for that to happen. You don't have to be like that. One of the things that I learned by reading 100-year-old books about what's this guy's name? Jesse Livermore. Mm-hmm. It was a book called Reminiscences of a Stock Operator. It was written in probably about 100 years ago. And it's a classic. And what I learned from him was that if you have a thought about something, then just put a little test position out there. Just see, just test the water. Just throw a little pebble out in the pond and see what kind of ripples that it has. And then if that starts to work, then add a little bit more to it. So his whole concept was to add to a winning position, which is the exact opposite of what most people do. Most people wait for the perfect moment when they are completely right, which will never feel very good to do, right? Your best entries will always feel terrible. They'll feel like, well, this is a waste of money. This will never work. And those end up being the right ones. And so this is why it's important to just test. Or maybe the opposite way is like, hey, I'm going to sell just a little bit of this position because I'm seeing a little bit of weakness here. Maybe, and if it continues to get weak, I can sell a little bit more. But, not thinking of this position in terms of just like this is a fixed, immovable object. You can always trim and adjust and do whatever you want to with it.
Yeah, I fully recommend Reminiscences. It's such a great book. I remember reading it in London, and I followed that up. This is when I was going through I'm a trader phase, and I ended up reading. I think it was actually on your suggestion. I read Trading in the Zone, which really is like it is a fantastic book about trading psychology. But what I realized that Reminiscences is just that is the original piece. And then Trading in the Zone was basically a modern, more textbookified version of all the interesting, fun stories that Jesse Livermore tells through actually lived experience. So it's a fantastic read, and I strongly recommend everyone check it out. The other one that I think is really interesting is that people, we've probably all been there, right? Everyone tests their hand at trading futures and leverage and all the rest of it. And you buy a position and it immediately sells off. And you hold it and you hold it and you hold it. And eventually you get blown up on the long side. And we actually saw this for this whole ETF rally. The dominance of people getting blown up in futures was shorts, and they kept betting against it and betting against it. And of course, they decided to flip bearish at 73,000 and go, oh, that's it. I'm tired of getting blown up on the short side. This thing's going to zero, right? Oh, sorry, no, it's going long. And they go levered long at the top. And of course, that's the exact moment when it goes the other direction. And that, at some point, I wrote about in my most recent piece, one of the indicators that will tell you that we've probably hit some kind of a low in this current correction is all those guys who have been blown up long, they go, okay, you're right. The Twitter guys are correct. We're going to 10K. I'm going to go max short. And once that happens, that is the indicator. When these guys get blown up, that's probably when the bottom gets put in.
Yeah, absolutely. Which is why, if you have a thesis about something, just test it and add to a winning position, right? But one of the things that I always talk to people about, and there's really two rules that if they could just find a way to add two rule structures to your trading, it will completely turn things around for you. And number one is ridiculously simple. Number one is define your exit before you enter the trade. Most of us just, throw our money into a trade and go, well, this is going to work out great, because otherwise, why would you do it, right? You never enter trades that don't feel good. And then when it starts to work against us, we don't know what to do. We're kind of a deer in the headlights. We're paralyzed. We don't know what to do. And it's quite simple. We never get any smarter once we enter a trade. We get dumber. So just writing down like, okay, this is my exit. This is what I will do. This is how I will close out the trade makes a tremendous difference. And then secondly, what I call the rule number 2 is golden rule of risk management. Never risk more than 2% of your capital into any one specific trade. And a lot of people complain about, 2%, that's, maybe they're starting with this $5,000 account or something even smaller than that. With spot, you can put different positions in different places, right? You can add to winning positions, you can take away losing positions. There's lots of ways that you can use money. But a lot of us are just used to this sort of, I don't know, Walmart mentality of like putting your entire account into one trade, or should I say Tesco mentality. Either way, right? So it's just simple things can make all the difference in the world.
Yeah, and I think writing down, in fact, my old man's, he was like, way back, he's just retired, and he's like, I've got this money that I need to obviously survive on. He's like, I want to test my hand at the stock market. I said, okay, one of the things you should do is you should immediately write down what your edge is. What is your advantage in trading anyone's stock or Bitcoin or whatever it is? What is your advantage? And didn't even know what the word edge was, right? So understanding what exactly is your edge, writing things down helps you realize what you do and what you most likely don't know. That's like the first thing, that if you can't put it down to paper, you probably aren't there on it. And speaking of edge, there's obviously a million and one indicators out there from the technical world, from the on-chain world. I know in my like early journey, you go out looking for it's like a very natural thing. You get blown up a couple of times and then you go looking for the indicator, and then you find the indicator, like, this is going to make me rich. It doesn't make you rich. You start losing a bunch of money because you have no idea how to use it. After 20 years in the market, how did you narrow down or go through that sorting process of what indicators actually worked for you, and what's kind of like where did you end up on that that plan?
Well, I'm really no different than anybody else. When I first started trading, I loved, being a former engineer, or I guess still an engineer, but just not employed with one, more of a financial engineer, I guess you'd call it, is that I loved all of these studies. Wow, look at the Arun oscillator and look at stochastics and MACDs and look at the histograms and negative divergences and all that stuff. I loved it, and I loaded up my charts, to the point where it's like you were looking at hieroglyphics. And then what I realized is that after a while, especially when I was doing futures day trading and just some crazy stuff, I had too many moving parts and it was just too much to watch. And, I would have one time frame doing one thing and another one, and everything was pointing in different directions. And so over time, what I've come to learn and to appreciate is just to read price action, just to understand what the price is showing. Now, whether you use candlesticks or whether you just use or candlestick patterns, or whether you use bars or Renko charts or Heiken Ashi, it doesn't really matter that much. But understanding, to read the flow of the price action, like an uptrend is higher highs and higher lows. This is standard Dow theory from the 1930s, just basic stuff. So the longer that I do this, the less that I want on my charts. I can now just trade based on what the price is showing alone. But the one study that I come back to again, which is part of this sort of discipline that I call fractal energy trading, splitting things up into multiple time frames and understanding the power of each time frame in terms of that trend. And then I use this in conjunction with a study I call fractal energy, which is really the choppiness index from a gentleman by the name of E.W. Dreiss. Maybe 30 years ago, he came up with this thing. And really what it shows is the linearity of the current trend at that time frame. So you can think of it this way. You can think of any natural or physical system on Earth right now. Anything that runs off of Newtonian physics operates in the same way. We go as far as we can, and then we rest. And then when we're ready again, we go as far as we can, and then we rest. You can use that with a car. You go as far as you can, and then you have to refill the tank, or you have to put another charge into your battery. You're not going to summit a mountain. You're not going to speed climb up a mountain in one day. I mean, Mount Everest, it's only what, 5 miles up? That's no big deal, right? But you're not going to make it there in one day. You're not even going to make it in 1 month. You're going to go as far as you can. You're going to stay at base camp one probably for a week because all of a sudden your lungs can't deal with a lack of oxygen. You have to acclimate to that. So once you consolidate at base camp one, you're all pumped up, you're ready to go. You go up to base camp two, maybe. And this is how markets work. They trend and then they consolidate. Range expansion, range contraction, range expansion again. It never stops. Sometimes the range expansion is in the opposite direction. So what I needed was a study to let me know when something is resting and is ready to go. It's almost like a spring being wound up, right? You can watch these things. You can see the power of markets that are just going sideways, and you know that they're going to pop. And that's what the CHOP index helps me understand, is when to expect to see that big move. And conversely, on the opposite side, when something's been trending for a long time, this is when everybody's chasing after it. When do I step in front of that, maybe take an opposite position or look for some type of range contraction to come into play? Again, the choppiness index will show me when something is exhausted and to start to anticipate that. So again, I'm not predicting the future. I'm just using the probabilities of these statistics that are based on this study to know kind of the different phases that are happening. And if you really get good at this, and this is what I consider to be the superpower, is when you can look at different time frames. So the monthly chart is going to have a different signature and a different trend than the weekly chart, than the daily chart, and maybe even an intraday chart. And if you can put all those puzzle pieces together, I can look at a chart and tell you where the trend is, where the strength is, where support is, what it's likely to do, or the levels that, if they are broken, signify a trend change. So to me, it's very simple. It's very fundamental. And again, we're not predicting the future, but what we're doing is we're setting a framework to say, okay, if it goes above here, it's bullish. If it goes down below here, it's bearish. This is what to do. This is how to act.
G'day folks, I just want to take a very quick moment to remind you of our partnership with the Bitcoin Advisor, who are market leaders in the world of multi-sig vaults, collaborative security, and inheritance planning. As I grow older, I found myself thinking more and more about that long-term question of what would happen if I didn't come home one day, but also the security and peace of mind of how do I secure my seed phrase and my coins for life. Now, what I decided to do is run my loved ones through a test, and without any of my guidance, spend a coin from my cold wallet. And what I quickly found out is there was a whole laundry list of ways that my coins could have become lost, locked, or sent to the wrong address, and I just didn't have the confidence they'd be able to access my proof of work if I wasn't there to help them. So the Bitcoin Advisor has a team of people around the world. Many of them are my friends, and you've seen them on Twitter, podcasts, and in the conference circuit. They are there to help onboard people and remove those single points of failure, many of which you may not have thought about in your long-term custody setup. So if you are interested, head over to our landing page in the link below, book a free, no-hassle consultation, and secure your coins for life. Thanks, and let's get back to the episode. What I like about, so just for people with the choppiness index, the best way I can describe it, you can look at it like a 14-day period, I think is the standard. And it basically looks at all of the candles over the last 14 days, how many of them are within the same range. That's probably the best way to think about it. When you've had 14 candles that are just stacked on top of each other in a rally, you're going to have a low choppiness index because it's saying that very few of those candles are in the same range. And when you're having a consolidation, they chop around within the same range. And you can also get a sideways, or if you get a correction, you're actually backfilling the uptrend. So you've got more and more candles within that range. So a correction is like pulling back the slingshot. And I think you've used that analogy before. It's like loading back the slingshot to just recharge people's expectations. You give the bulls an opportunity to get in at a lower price and kind of put that support in there. And I think the other thing on the time frame thing, it's so important. One of the big lessons I took away from you is this concept of reversals starting from the inside out, where the bear market starts on the 1 minute chart. You can't tell yet, but then once it gets bad enough, it becomes a 1 hourly bear market, and then a 4 hour, and then a daily. And that daily bear market will have a series of bull and bears within the context of forming a weekly bear market, right? And then eventually that weekly will get so bad that it becomes the monthly. And using that as a context, in our current market, it's actually quite interesting because the way I've been looking at certainly probably the last, let's say 2 years or 18 months, we had a tremendous uptrend, like 18 months of just almost up only from the FTX bottom at 16K. This is this long kind of trending market. If you've got 18 months of up, you're probably going to have something in the order of 6 months of sideways to down. That's a comparable scale. How do you think about that kind of just broad context of where the market currently is, and how to really think about within the context of range expansion, range contraction, time frames, all those different dynamics?
What we've been in since the top in April is what I consider to be a monthly bull flag. And a bull flag, for those of you that don't know, is basically you have a flagpole that goes up and then you see a slightly descending consolidation. And most of us get caught up in the ebbs and flows of the daily chart. What we care about, like, is it up today or is it down today? Is it up today or down? So most of us just sort of narrow in on the daily chart. That's all we look at. But if you zoom out to what's happening, and maybe we can look at this later, but if you zoom out to what's happening on the monthly chart and you say, oh, you know what? This is a cup with handle pattern, which has got a measured move of 122K target. Okay, so this is going to take some time. And back in April, I was saying, okay, you might not want to chase after this one because it's exhausted. Like going back to the CHOP index, when it's got a very low value, I equate that to like a fuel gauge. It's empty. And you might be able to coast to a few more miles on fumes, right? But at some point it's going to stop, and it's maybe it'll slide back down if you're trying to climb a hill. So the opposite of that is where we have a full tank. We've consolidated for a while, and right now we actually do have a full tank at the monthly and at the weekly chart, although the weekly is starting to show a little bit of decay to the downside with the trend that we've had down lately. But still, the bigger picture here is that this is actually a very clean, very orderly consolidation that we've had for the past, 6 months now? Close to it. And, people are starting to lose their minds right now because we have not broken out. But if you look at every major rally that we've had for the past several years, with very few exceptions, and probably the biggest exception is 2017, which was just a monster. That to me was like the 1990s in the stock market. Nothing was going to bring that down until we hit our targets. But in today's market, the last several bulls that we've had, we don't break out from a consolidation. It doesn't work like that. What we do instead is we pull down and convince everybody that the party's over. One step back, boom, 2 steps forward. So it's almost like, as we say, drawing back the crossbow and letting it fly. So that's, right now, it's playing out pretty well to pattern, as I would expect. And right now, certainly a lot of people bearish, a lot of people giving up, folding up their hands and saying, I'm going to go back into multi-level marketing or something like that. I don't know.
Putting on their McDonald's hat is the typical meme.
Yeah, where's the dumpster for Wendy's?
Yeah, and what's really interesting is like a lot of these ideas, I see it playing out in the on-chain data as well. So one of the metrics that I would equate as a similar ballpark to the choppiness index, it's a thing I call the sell-side risk ratio. And basically we can measure every coin when it was purchased on chain and then when it's disposed of. So that disposal profit or loss, we call realized profit or loss. And the idea of this metric is we sum all the realized profit and all the realized loss and divide it by how big the market is, the realized cap or the market cap. And the concept here is that if you're consolidating, what happens is this metric also trades lower because all the profit that was going to be taken has been. All the losses that were going to be taken has been. And investors reach this point where it's like, I need the price to go somewhere. I don't care if it goes down, I'll panic when that happens. I don't care if it goes up, I want to be greedy and take profits when that happens. But it tells you all that profit and loss that was going to be taken has been. And it's this like squeezing up of the market. It's ready to go. It's like, like an olive pit that you squeeze it hard enough and eventually it just shoots out. That's essentially how it goes. And usually you need these capitulation candles. So I often look for, there's a metric called SOPA, which basically looks at all the losses. And I want to see when all the people who bought recently, particularly those who bought near the highs, I want to see when they lock in just extraordinary losses, right? If you're going to be Warren Buffett, you want to look for blood in the streets. You want to see all the guys going max short at the bottom, and you get this confluence of things saying, hey, this is now getting so bearish that everybody believes it's going to 10K, probably not going to 10K.
The other thing to do, and people forget about, is volume. Volume shows when somebody's in pain, because people in pain, or people, normal trading doesn't produce a whole lot of volume because there's no disagreement. So for every buyer, there's a seller, and it's things work out nicely. But during periods of pain, and we can see this to the upside and to the downside, this is where we have huge disagreement and big time volume. So kind of like bear tracks, we see a big volume spike as that capitulation. And that's something I was looking for and I never did get back in 2018, 2019. We really never did get the capitulation spike that I was looking for. And I think a lot of that is because so many people held fast. And so the people that capitulated were actually a relatively small number of that. But the further up that we go, the more that, that was at 3,000, 6,000, it wasn't that big of a deal. But the further up that we go, the more is at risk for people, especially that bought in at 70,000. And so, when they're looking at 42,000, what are they going to do? Are they going to hold in there? Are they going to be, are they going to be believers, or are they going to just say, yeah, McDonald's, here I come?
Interestingly, we can see that volume in the realized in on-chain data. So interestingly, you can see what type of volume was it, and when you see at particularly bear market floors, obviously people are going to be locking in losses. But the one that really is the signature is when the people who just thought, shit, I wish I sold at 20,000. All right, I'll lock in whatever profit I have at 3,000. You get profit uptick as well. And when you get that signal, you've got people who are going, oh my God, this thing is going to zero. And you can see that absolute pain where they sell their profitable coins, despite the fact that that's probably going to be the low. That's one of those interesting dynamics. Now, before we jump in, because I do want to actually pull up a chart and just kind of explore where we are, because I think that taking a lot of these concepts and sketching over, I actually just wanted to quickly touch on something you mentioned at the start of the call. And that is the concept of futures, manipulation, options. I can't begin to tell you how many people keep saying that, oh, the market's manipulated because it's not going higher, right? If it's going higher, no one cares about manipulation. It's only when it's not going higher that people say there's manipulation. Now, these things do play in, what people will classify as manipulation in futures is kind of also just how markets work. So there's this to and fro there. You've got a lot of experience in the derivative space, and the derivatives market for Bitcoin has really expanded over the last 5 years. It's been since 2018, really 2020 onwards, it's a different market structure as a result. What's your general view on how options and futures and stuff, how do they actually impact price? And when we think about that, how does this current last couple of cycles, how will it differ and change relative to previous cycles, particularly as options come out for these ETFs?
Well, the first thing that we saw was in the stock market itself, stocks used to trade very organically by themselves. And then around the 1970s or so, the options market came into play, but it really didn't impress itself upon the market until I'd say the last 20 years. And now the options market almost controls the stock market based on who's selling what, because a lot of these institutions are selling options to generate cash flow. And to do that, they have to set up these huge, enormous positions, and then they have to basically delta hedge against them. So that creates this, what's called pinning, where the price will run to a specific strike price, or in this case, the underlying price, because of that option and the effects of those huge positions on there and people hedging against them. And we are just now starting to see that into the crypto space. And I think we will see that even more as we get options on the ETFs that have been printed, because that's where you get your $1 trillion influence, is when you start to, what is the equity market now? It's something like in excess of 50 or $60 trillion. When some of that comes across the bridge, that's when it really starts. We just saw a little bit of that at the beginning of this year, but we will start to, Deribit itself is not going to move the market, the crypto market, Bitcoin or Ethereum by itself that much right now. But when we start to add the influence of these ETFs, I think that is what's going to really, really do things. I'm kind of skeptical about the influence. People talk about, oh, look at the Chicago Mercantile gap in the futures, and like all gaps must be closed. I think that's a little bit people grasping at straws, looking for things that they don't understand. There is some element of that, but it's more of, to me, gaps do not have to be closed to close some kind of hole of entropy in the universe or anything like that. It's more of gaps get closed because you're out in the middle of the Arabian desert and there's a single red flag that's sticking up about 500 feet away, and you're like, hey, what's that? Let's go find out what that is. And so that gaps attract people saying, hey, there's a target, let's go get the target. So those kind of things happen. But I think the real story, to answer your question, I think the real story will come with all these derivatives that come porting over that bridge to the traditional finance world. That's where you're going to see the real pinning of things. That's where you're going to see a lot of money coming in, a lot of money coming out, and a much more influence in terms of derivatives.
Yeah, because a big development over the last 18 months or so, options have now, in terms of open interest on Deribit primarily, they're now as big as the futures market, which is a huge development. They're up at 20, 30 billion, give or take. Futures have always been dominant. They used to be like 10% for options. Now they're of a similar scale. And this is before they go fully institutional. And the other one is that the CME in futures has overtaken Binance for open interest as well. Not yet for volume. Actually, Binance still dominates in terms of trade volume. But in terms of open interest, we've seen a lot in the CME and a lot of stuff going on with cash and carry trades, where the futures are trading just a little bit above. I think you'll be able to track like a 10% premium on a rolling basis. So essentially these guys will buy the spot ETF and then sell the future to lock that in. And one of the dynamics, because a lot of people say, well, hang on, isn't that suppressing the price? And I spent a bit of time thinking about this, and I might run this idea by you. For the trader, that's obviously a neutral position because they're long spot ETF, short future. When they go to unwind that position, however, the ETFs are much less liquid than the futures market. Futures are 100 times bigger. So if you want to unwind that position, you can long the future, which it just gets absorbed. But if you're selling the spot ETF into a relatively liquid book, you can actually have a net negative on the overall market. Does that logic make sense?
I haven't thought of it through that to that extent to this point. It's almost what you're suggesting is almost like a pairs trade because you're long and short at the same time because of the hedge. But yeah, I see so many hedges. Like that's the problem that we see a lot of times when we see these big tails on moves like that. It's because of liquidations, and people have had to hedge against their position, delta hedge against that position with futures just to, so when that all comes through, that's where you see these big volume spikes.
Yeah, it makes sense. Well, if you want to, we can bring up a chart and kind of just go through. I mean, there's a couple of things I want to look at. One is just how you're thinking about taking all the concepts we've talked about, how you're thinking about the current price chart, but also how it compares particularly to maybe 2019 or the previous 2021 period, because you mentioned earlier that it's very structured. And that's been something that I've had as like a theme. When I look at this current consolidation and this current correction, it has been remarkably more structured than certainly what we saw in 2021. 2021 was just complete chaos. The swings were off the charts, right? 50% ups and downs. I strangely think that we hit an all-time high in that bear market. So the bear market, in my view, started in mid-21, and then we still rallied up to new all-time high. But sentiment was very, very dead across almost every metric. So from that lens, you kind of had this like highly volatile. It was technically sideways over a multi-month period, but really, really very different to our current market structure.
Okay, so the way I typically will look at things is I'm going to look at things in multiple time frames. So here's the monthly, here's the weekly, and here's the daily over here. So this is the child time frame, right? So I cared the least about this one. And this is what most people are looking at day after day after day. But if you look at this, this is a rounded base. This is what's called a cup with handle pattern. Now, a little bit of this is to some degree like tea leaves, watching things. But if you think about this, this is market psychology, which has been distilled into a visual pattern. And the way that you can look at this is the depth of this cup pattern, which is this delta here, which is going in between, say, 16,000 to 70, 72, 73. You can project this same distance to the upside. And that's why I talked about 122K before. So that's, it's not to the penny or anything like that, but it's just a general format of things. So that's my overall assessment right now, is that we're in a cup with handle pattern. We're currently printing the handle pattern right now, but also looking at things like this, like what I like to see from things is rising patterns like this are bearish, right? So a rising pattern is bearish eventually, but what I typically see from those in a rising pattern is that I will see the price pop out of the top of this before it starts to show weakness. Now you can flip that same thing upside down as well too. Descending patterns are generally bullish over time. But what I want to see first is it actually pop out through the bottom of this pattern in the exact opposite way over here. And this is where, to your point, this is where everybody's going to go dead short. Like if we break 48,000, everybody's just, all the traders that are out there, institutions, hedge funds, are going to say, all right, this is it. Bitcoin's going down to 32. And they're going to want a piece of that because they think that that is the low risk entry. It's not. The low risk entry was up here, right? This is a very high risk entry, but they don't realize that. And this is why a lot of times we can see moves just like that. We see it poke down below here and eventually rise above. So at what point will I say that I'm wrong on this? If I go back to something like, I'm just going to go to a single price chart. So this is what everybody's got to do, right? You've got to look at this and say, at what point will I be wrong with that perspective? Volume profile can be very, very useful for this sort of thing. And right now what we're showing is the volume profile. There's a huge value area, which is right over in this area. And it's bounded by about 54 to the bottom of this. And we're right around that area. Now 52, there's a small value area here, 52, and that could be support. The next one is down here at about 42. So that to me looks pretty good for that. Now the other thing that we can do on here is just do simple fib retracement. And the fib retracement, if we take the beginning of the swing, and I'm not sure whether we're going to take that from, let's call this the FTX lows. And so if we take this from the FTX lows down here, let's try this again.
Interestingly, Doc, I did a piece called Finding Fibonacci Flaws, where I used this concept of, because a lot of people look at Fibonacci's, and it's fascinating to me how these like mathematical numbers come into play all the time. But what I then overlay is many of the on-chain models, and a lot of these are looking at cost bases. And more often than not, when you've got one of these big, I would call this like a big event type thing, everyone's looking at it, they think it's a bull and it's going through this correction. Almost always it will come back and touch like the 50 or the 61.8, and you'll always have some kind of cost basis level there, which is like a point of like absolute maximum pain for a large cross section of the market, where they just see all their portfolio go red. And that's, again, one of those like confluent zones that really, really makes sense.
This is where everything starts to line up with itself, right? So you can start to see confluence here. The 38.2 retracement is a very, very good level to come back to. And I'll show you this versus the 2021 in a minute here. But we can go down to, it's valid for us to go down to the 50% retracement, or as far as the 61.8. And that's what we did in 2021. We went down to the 61.8. So this one is just a baby correction so far. This is a very well-ordered consolidation so far compared to 2021. So for us to go down to 38,000, how many people do you think would still be holding at 38,000? Probably very few at that point. We'd probably see a big tail down here, and I think we would see a capitulation event that would knock your socks off. Now, if we go back to the 2021, this is really interesting here because let's see, I am going to get rid of volume so I can not compete against that. And if we go to this fib retracement, if we go to the COVID lows up to the 2021 highs, notice how the price came down to just about the 61.8% retracement. Again, that's sort of the last line of defense for the bulls. If you go past the 61.8% retracement, you're more than likely going to fill in the entire triangle on that point. So this is why I watch this very carefully, and you can still take a pullback down to here. And in fact, that's going to be maximum pain down there. It's going to be super bearish. It's going to be, this is where you're going to see liquidity events. But notice how fast that it ripped off of here. So compare this, all this mess here, and I do agree with it. I think we did sort of move into a bear back in the latter part of 21, just before we hit the highs, because normally the junk is what rises to the top at the end of it. So everybody's looking for alt season right now. We're way, way, way early on alt season for that. So compare that versus what we have here, and this is a much better, much more organized chart that shows real structure to what's going on. But if you get lost in that, if you're just looking on the day-to-day.
Yeah, absolutely. And this is one of those, you can see in the volume profile here, I use this concept called top heaviness, which is this concept of what actually starts and creates a bear market. There's really two things. One, when too many people buy too many coins at too high of a price, and we can measure that as the price falls, people's unrealized losses increases. But then there's also the magnitude of the damage, right? Just because someone bought a coin at a higher price doesn't necessarily mean, like, it's one thing to be underwater, binary, in profit, in loss. It's another thing to be down 30% relative to 5%.
Mm-hmm.
And what I've noticed in this particular correction is that even though we are trading, I think we're about 25 or so below the all-time high, 25%, even so, the amount of unrealized loss held in the system is actually remarkably small. Very, very similar to 2017, 16 uptrend, 2021 during the up legs. We haven't seen this like major flush out of people being in 30%, 40% down. So as a result, that's going to impact overall psychology. People aren't going to be as stressed. There's going to be a lot of hodlers out there who are like, well, I've carried a couple of 85%, 25, I'm not really batting an eyelid. But it also tells you that a lot of people haven't bought at 73. A lot of those guys have already been washed out. A lot of people actually have bought their coins around 60 and around 50, 58. That zone, which is, if you're down at 54, you're down a couple of percentage points, not down 30, which can break people's sentiment.
Yeah, I'm just looking at the structure here from the 2017 move is quite exceptional because this is the only time that we've seen consolidation breakouts that stuck. So consolidation breakouts, pullbacks, everything was very, very linear about that level. So, and then we had, basically a year and a half of just utter trash. This is the 2019 move. The 2019 move was almost like an echo of 2017, 2018 was almost the same shape. But in all cases, what started the next cyclical bull was a volatility event. And I see this in all markets all the time. I mean, you can go back to 1987, the Black Monday. That started, a bullish event. The COVID lows across markets started a bullish event. It was a cyclical event generated. Even Brexit started a bullish event back in 2016. So you can look at all of these events. Now, do we need something like that today to get this next thing kicked off? Perhaps. I'm not going to rule it out. And it actually would probably, talk about, trading some short-term pain for some longer-term we could see something very similar to this. If we come down to one of these fib retracements, which lines up in confluence with, in this case, the point of control, which is at about 43,000 on the volume profile, this would generate, you'd have all the weak hands completely flush out. You'd have institutions lining up, waiting to get on board. They are extremely disciplined. They will not buy. They will not hold their nose and chase after price. Unlike a lot of hedge funds, but a lot of these institutions are value based, and they will absolutely wait for the right numbers to come in. And that's what I would expect to see short term, something similar to this coming along, a quick volatility event. Jobs report came out today. It shows that we're potentially softening well in advance of the Fed meeting in 2 weeks. We're starting to see some evidence that the Fed is too weak, too late to catch this thing. And that is the very real fear that we're starting to see. We're starting to see volatility tick up in all markets right now. So this is not going to stay quiet. In fact, I think it's going to get louder before it's going to get quieter.
Yeah, no, absolutely. And this is the dynamic, right? That range contraction, range expansion works on volatility as well. The market goes from very, very quiet periods, you wind up the spring, and then you get a period of higher volatility. And I've been describing this thing as chop solidation, named partly after the chop index, because that's really what it's been. The call was back in May. Close your eyes for 6 months. We'll be at the exact same price, and longs and shorts will be liquidated left, right, and center. And that's more or less exactly what has played out. People have been liquidated left, right, and center. And as of just a couple of weeks ago, it was 5 months, and we were at the exact same prices when I wrote that piece. So very much like close your eyes, same place. You can ignore a lot of the noise, and but people will trade both sides.
Yeah, I'm really looking forward to getting some better. Unfortunately, in the U.S., we don't have very good listed options for this. But during markets like this, you can clean up by selling options above and below the current range. You can sell them, sell calls above, sell puts below, and this is where your income can come from. And so, you can make a tremendous amount of money on a directional basis, but then what you can do is you can rent out your assets at this point and, selling them. And so I'm kind of looking forward to some improved derivatives in this market. I think futures are actually pretty good, and I'm a little bit jealous of what you guys have with Deribit, but they will not let us open any accounts anymore. I used to have an account there, and they're like, "Go away, we don't want you." Actually, the CFTC just went after somebody else for allowing U.S. customers on, so they are just completely out of their minds in terms of being punitive about this sort of thing.
Yeah, I think the options with the ETFs will be a big change, right? Because it gives institutions, but also it creates opportunities for hedging. These big institutions can't put these positions on without significant tools available and highly deep markets to actually hedge their positions and manage their risk. Right? These are all the different dynamics that these folks actually need in order to trade these markets.
Yeah, so like iBit is one of the. I think this might have been the BlackRock one. So if you look at something like this, it's a $30 per share stock, where you can control an amazing amount of that leverage with a very cheap option, and these will be extremely popular when they are listed. And so we're hoping that Gary Gensler gets out of the way at the U.S. SEC so that we get these things listed, because I'll be slinging these things like crazy once that happens.
Yeah, that's in the happy place. Well, Doc, that's fantastic. Just to kind of bring everything in and wrap everything up. Obviously, markets they're challenging, they're counterintuitive. People, our natural instinct is almost always wrong. For people who are, a lot of my audience, we did a poll recently, and 95% of people identified as hodlers rather than traders and finance professionals and all that. Most people are in that hodler bucket where they're around. They understand why they own Bitcoin. They want to understand why the market does what it does. For people who are coming into markets and getting into financial markets and kind of learning the ropes, what are some key tips for just surviving, and like what's some just simple advice for people to kind of stick around and make it to the other side? Because so many people come in, I did it many times. You have to blow up an account or two to kind of learn your lesson the hard way, pay your tuition. But like, what are some tips you've got for people to navigate these things?
I would say my number one tip is what worked for me, because I told you about my background of, like I was just voracious about like learning different markets and different indicators and different charting techniques and, how to trade this and that. And I'd become a really smart guy that wasn't making any money. It was enormously frustrating to know all of this stuff, but it was like, it was like being in a library. Like, okay, you know a lot, but it's not making you any money. And so I really, really wanted, at that point, I was feeling a sense of desperation to get out of my existing employment, because we were just sitting in offices on conference calls yelling at each other because our company had just been acquired. I was part of a huge telecom merger that happened back in the mid 2000s. So all these 3-letter acronym companies got like merged together, and all we did was yell at each other, in conference calls. That was no fun at all. There's no accomplishment of anything. So I had this desperation to get out, and I had this inspiration to make this work. And I was like, it was not working. And so in kind of a fit one day, I was like, I just swept my desk off and I was like, all right, enough. I'm going to pick one thing. I'm going to pick one time frame. I'm going to pick one strategy. And that's all I'm going to do. And I'm going to be an idiot savant, and I'm going to excel in this thing. And I was surprised how quickly things turned around for me. We all bounce around from one thing to another. We get excited by one thing, or, hey, look at this coin, it's moving, or we're chasing after this or that, or, we're like, a dog and seeing squirrels all over the place and not really knowing what to focus on. So I found something, and this is not my term, but I love this one. It's called find the rage to master. Find the rage to master. Find something that you obsess over. And it's pick one thing. Find one thing to be really, really good at. And write down exactly what your plan is and what you're going to do. And dedicate yourself to that. And I think you'd be surprised at how quickly you can. Because you're going to iterate like crazy, right? Iterate like crazy. And it's almost like those... sometimes the hang gliders and people that learning how to parachute, what they would do is they would put a tow line behind a car, and they would drive in great big circles, and they would, eventually, rise up on the hang glider and then cut themselves loose. It's kind of the same thing. You want to be spinning higher each time, every time you take a trade, get a little bit better at it. And, what I'm saying is that you will get very good very quickly doing something like that if you know what you're doing, and if you apply standard principles beyond this, just change one thing at a time. Don't change everything at once. And so that's really the key. That's the Holy Grail, is to find something that you believe in, so you allow your subconscious mind to succeed, because that gets into the whole, noggin area of this, where if you don't think you've put the work in, if your subconscious mind feels that you've cheated the process somehow, that you've made money too easily, you will find a way to give it back. And that's another one of these unwritten rules of trading, is that you actually have to do the hard work to get to the point of being good at this stuff. And once you're good, then your brain will say, okay, knock yourself out. Go do it. Go be successful. But finding your one thing. And there's a great video. There's a movie that came out maybe 30 years ago, which is called City Slickers. And if you look at a YouTube video called Curly One Thing, there's like a 3-minute video of this guy in this movie called Curly, who's the toughest cowboy that ever lived. And it's this great little scene with Billy Crystal in here, who's trying to find himself. And Curly gives him the advice that he needs, and it's about one thing. So find that, which that changed my life, that 3-minute video. Finding my one thing.
That's great advice. And I mean, from my side, it's find a good mentor because when you go through these processes, people have been burnt by all these things many times. You'll hear people talk about it until you go through it yourself. You really have to experience these things, but at the same time, you can fast track by finding someone who's done this before. And again, I can't thank you enough for all the lessons I've learned over the years. And there are doc signatures all through the world of on-chain data. It's absolutely spread throughout it. So thank you so much for coming on, and let people know where they can find you and follow your work.
If you go to readysetcrypto.one, they can find me. So there's actually a free trial if you're interested. And you have access to every class that I've ever done, as well as the signals that come in. So we actually look for signals on the top majors. And if any of them are showing we're looking for bullish signals at this time. So, but that's readysetcrypto.one is something I started with Mav about 6 years ago. And Mav's out there trading the world. He's the one that got me into crypto those years ago. And so carrying the flag.
Yeah,
So
no, that's
thanks
fantastic.
very much, James, for bringing me on here.
No, it's been a real pleasure, and you guys actually gave me my start. I started writing and discovering Bitcoin and writing about it, and all this was actually my first gig in this space. It was a side gig at the time, but it slowly evolved into a company. So it really has been the seed that got me here. So thanks a lot.
Well, you're doing amazing work right now, and you're to some degree the technical analysis that I do is a little bit of tea leaves and try to read between the lines of things because we don't really have the detail. We don't know who's buying and selling and things like that, but you do. So your on-chain analysis is really amazing stuff, and so hats off to you for pioneering that and bringing it to the people.
It's amazing to me that institutions haven't cottoned onto it yet. The fact that you can see a cross section of every coin and every investor, how long they've held it, how much profit they're in, how much they're taking, and try convincing institutions that this is going to be useful information for them. It's a slog of its own.
I got a number of Goldman Sachs you can call.
Yeah, no, I'm quite happy having I can write down my edge on my page, and I know what I'm here for. Good stuff, Doc. Thanks a lot for coming on.
Okay. Thanks, everybody. Thanks, James.
Cheers.